Hey everyone, and thanks for jumping back into the cryptoverse. This is a premium list video only, so if you are subscribed to the premium list, thank you for your support, and I hope you find this information valuable. The report we covered last week was the Quantitative Investor 1.5. We looked at the best day, historically speaking, to buy Bitcoin by taking into account, the data over the last 10 years, and the data suggested that Monday, opening time UTC, is the best time to buy Bitcoin compared to the other days of the week. And we looked at this compared to, say, various moving averages of reference points. So comparing the instantaneous buy on that day to a moving average that was preceding that buy. And how much higher up would you be buying it compared to the historical price. And the reason why it's always positive is because the price of Bitcoin tends upwards over the macro scale. Therefore, it's usually better to just buy earlier. If it's between, say, this year and next year, then historically speaking, it's better to just buy earlier. Of course, there are speculative bubbles that will sway some of that, but in general, it was better to buy earlier. And then looking at certain days of the week, if you're setting up, say, a dollar cost average strategy, whether it's static or dynamic, what day of the week do you pick? Do you pick Tuesday? Do you pick Friday? Well, the data showed that Monday is the best day to buy Bitcoin, UTC time at open. Alternatively, this week we're looking at Ethereum. This is a popular, probably the second most popular coin right after Bitcoin, so I figured it was worth looking into. So the best day to buy Ethereum is in fact Friday. And this is valid across all four time frames that we investigated. You can see that if we compare the percent difference between the price and the moving average of the 7 days prior, then buying on Friday is around 0.6% higher compared to Thursday, which is 1.25% higher. This is actually a pretty significant difference here. And the second best day to buy Ethereum is Saturday. So, if you miss Friday, you don't want to wait for the following Friday because in general, things tend upwards over time. Then Saturday would be the next best day. Now, obviously, in any given week, Friday could be the worst day to buy, and Saturday and Thursday could be the best. But if you're just, say, setting up a systematic strategy to just do it constantly for the next, say, 1 to 2 years or something like that, then at least the historical data suggests that Friday is the best day to do it. Now, clearly, we could move forward in time 2 years and then come back and test to see if that was true. But at least what the data historically is telling us. So Friday is the best, Thursday is the worst. If you think of this a different way, you could think of it as Thursday could be the best day to sell, in a sense, for those who are wanting to, continuously take profits, whether maybe you're following a conservative risk tolerance approach. So anytime that the risk of Ethereum gets above 0.4, that would correspond to taking profits. If you look at the next three time frames, so compared to the 14-day, the 30-day, and the 60-day, all three of them also show that Friday is the best day to buy, and that Thursday is the best day to sell. So I think, if anything, try to avoid, again, this is not specifically financial advice or anything, it's just looking at historical data and trying to use that data to inform our future decisions. But you can see pretty definitively that Wednesdays and Thursdays, you probably don't want to be buying Ethereum. But Fridays and Saturdays tend to be better, and you can see it really shoots up on Sundays. So Friday and Saturday, if you're looking to buy Ethereum, it seems like these are among the best days to do it. So I hope this is useful. So Bitcoin is Mondays, Ethereum is Fridays. If there's another coin you guys want me to look at, I can do so. Just let me know. You can always leave a comment down below if you really want to see a specific coin. But we'll continue moving on for the sake of this video. So the second thing I would just want to give an update on is the logarithmic regression curve fit to the primary, the primary logarithmic regression line fit to non-bubble data. We talked in a previous public video about how every time we've had a halving that my video disappeared, but every time we've had a halving in the past that the price of Bitcoin tends to go right to that fair valuation line. And currently the fair valuation of Bitcoin is around $8,400 or so. So it's actually quite remarkable that, on the eve of the halving, we're watching the price basically go straight to that primary regression band, which was exactly the case in 2016 and the case in 2012. Now, of course, it's meaningful in one sense, but we also know that this data over here has all been fitted. So if you only fit this data, then certainly, it would have predicted a $1 million Bitcoin a couple years ago. But it is interesting that if you just fit this non-bubble data, which admittedly is somewhat discretionary, the price at the halving tends to fall right on the regression band, and we see a speculative bubble later on. And you can see that the time the speculative bubble occurs has pushed out further in time. So again, we expect this next cycle to be lengthening, and for us to be in this regression band for a fairly extended period of time. In terms of the risk levels, this is just a constant reminder of those who like to dollar cost average, and if you do it dynamically, the price of Bitcoin jumped up to $10,000, which corresponded to the 0.4 to 0.5 risk regime. In this regime, I reminded people who had a conservative risk tolerance to set a stop loss if you wanted to follow that strategy. So the lower limit of the stop loss needed to be $9,300 to $9,400 to ensure that you're taking profits in the 0.4 risk regime. If you choose not to follow the conservative risk approach, that is perfectly fine. You just have to recognize that you might miss out in the event that, something like we just saw, a move up to 10K and then a retracement back down 15%. Alternatively speaking, there is I've gotten a lot of people asking about, short-term capital gains tax and how you deal with that. There is this other model I've presented in the past in a couple other videos, but the basic idea is to have a systematic buy region and then a gray region. And then this gray region, maybe you buy, maybe you sell, but it could just be you don't do anything. You stop buying, you stop selling, you let your assets that you're holding, so you let your Bitcoin that you're holding mature in a sense, so that when you do take profits, it'll be long-term capital gains rather than having to pay those short-term capital gains taxes, say flip-flopping back and forth. So if you're worried about the taxes and you don't want to deal with constantly having to pay these short-term capital gains on all these different trades you're making, where you're seeing a somewhat adequate profit when it say goes up into this risk band and then drops back down. So an alternative approach is just you don't buy above a certain region and then you start selling once it gets past this region. So this is one approach that should help you get to a longer-term capital gains tax rate. Now, clearly, if we shoot up too quickly, then it still could be short-term in one sense of the imagination. But in general, this can help delay your moves from, say, Bitcoin to fiat and then back to Bitcoin. So if tax implications are a considerable thing for you to manage here, then consider this approach. The reason why I don't often publish this approach or talk about it is because I like to keep things super simple for the majority of the people on the public channel on YouTube. Just explaining, say, 3 distinct models rather than going through 100 different ways you could do it. But just know that this is one way you could manage it. And for those people wondering, well, what do you do when you're in this region and you still have, say, a disposable income each month? Well, remember, there are other assets you can be investing in, whether it's Ethereum, maybe you have a favorite other coin somewhere, or it could be, like traditional markets. It could be commodities. It could be precious metals. It doesn't always have to be Bitcoin or bust, because if you're buying Bitcoin in, say, the 0.7 to 0.8 risk regime, you are taking on a substantial risk. It's definitely more of a gamble, I would say, rather than, say, a long-term investment, which is what I feel people are making today. So at least take that into consideration when thinking about, okay, do I just stop buying Bitcoin for a year if it's in this risk band? Well, there's other smart things you could be doing with your money than just continuing to throw it at an asset that's maybe already up 3 or 4x. So at least consider that possibility. In the remaining charts here, we're just showing the risk level updates for the various coins. We're looking at Bitcoin, Ethereum. So here's Bitcoin, here's Bitcoin with the color-coded time dimension removed, and instead the risk is plotted on a secondary y-axis. We also look at Ethereum, the same corresponding chart with Ethereum. Ethereum has not broken into the 4.4 risk regime. And while I've said before, for Bitcoin, I don't start selling until we get to 0.5, but Ethereum, I do start selling at 0.4, just because the model, the risk model for Ethereum has not been optimized for diminishing returns or a lengthening cycle. And so I don't actually anticipate the risk level of Ethereum ever getting back to 0.9 to 1, at least the way it's currently defined. I would imagine that it would actually start decreasing. And the reason for this discrepancy between, say, Ethereum and Bitcoin is just Bitcoin, we have a lot more data. We have 3 market cycles to go through, whereas Ethereum, we only have 1 market cycle to really capture data from. So it's hard to really speculate too much on the exact nature of the diminishing returns, etc. So for Ethereum, I'm more so looking for the 0.4 region to begin dollar cost averaging my sells. And in fact, you can see 3 times in the last couple of years where we popped up above 0.4 only to retrace. And I want to remind you that we're on a multi-year journey. We're almost assuredly not going to $100,000 Bitcoin in 2020 or 2021. We're likely going to traverse these risk regions several times. And so it's okay to not get caught up too much and say, too much excitement in the short term. You can see here in the last cycle, we popped above that 0.4 risk band many times. And I mean, this is for Bitcoin. You can see we popped above 0.4, here, several times throughout this entire year. And then we came up to almost 0.5 and then retraced back down to 0.4. And then it wasn't until, in 2017 that we really started finally taking off. I've also provided the risk metric for Litecoin here. You can see the symmetry in terms of, I've talked about it before with Litecoin. Again, Litecoin is not one of, it's not a coin that I'm super bullish on. Do I think it could see a substantial move? Yes, of course, but it's not something that I necessarily use. It doesn't make up a huge percentage of my portfolio. But you can see, the symmetry, or maybe symmetry is the wrong word, but a similar move, going down into the halving, a spike right before the halving, and then retracing directly into it. So again, going down, moving up into the halving, and then right before the halving hits, we retrace. And then following that, we just, Litecoin just traded sideways for over a year. And this is what more or less I would expect Litecoin to do now, because as long as the lengthening cycle theory is true, and it's going to take a long time for us to really gather our senses and really build out a bottom here that we can build off of, I don't think Litecoin is going to be going too many places in the short term. Finally, we have the S&P 500, which I know most people don't really pay much attention to, but I would urge you to at least become familiar with it, because in maybe say 3 years or so, we're going to be most likely at the top of another speculative bubble. And you're going to want to take your profits and then not just let them sit in a bank account. You want to, continue investing those so they can continue to grow. Remember, we're only here for a limited amount of time. You want to make your money work for you. You don't want to just sitting there doing nothing, which is why in my portfolio, I also hold stable coins. And if I'm waiting for, say, a good time to buy in, then at least those stable coins are earning me interest, so that when the time does come to buy in, there's a little bit more of those stable, it's accumulated a little bit more. Those stable coins went out, they brought home a few of their friends, and I can use, my initial investment plus the friends that they brought home to then purchase more Bitcoin or Ethereum. So I hope this makes sense. I hope, you guys find these newsletters informational. I think the transition from a monthly report to a weekly newsletter has been a good decision based on some of the feedback I've gotten. I think going a month between reports for people on the premium list was too long. So hopefully these weekly newsletters accompanied by a video for people on the premium list only are sufficient for you guys to feel like you're getting, you're really learning something about the cryptocurrency markets. And it's not just say drawing lines on a chart, but it's actually looking at various models that are backed up by data, and then you can use this data and then squeeze information out of this data to help inform your decisions going forward. So that'll wrap it up for this video. I hope you guys enjoyed it. I will talk to you guys next week. Bye.